Hello and welcome everyone to the Capital Mind podcast. If you'd like to know more about us, visit capitalmind.in, and if you'd like to invest with us, do visit capitalmindwealth.com.
This podcast is for informational purposes only and should not be relied upon as the basis for investment decisions. Clients of Capital Mind may maintain positions in the securities discussed in this podcast.
Hi everyone, and welcome to a new episode of the Capital Mind podcast. In today's episode, we take a look at profit shares or performance fees charged by people when they manage your money. Over the course of this episode, we dive into who can charge a performance fee and when, what terms like management fee, hurdles, catch-up, and high watermarks mean, whether performance fees actually create skin in the game or the right set of incentives for the people managing your money, how losses and performance fee don't go well together, when does it make sense to charge a performance fee or profit share? As a customer, should you care about the profit share or only bother with your post-fee returns? And finally, how do you pick between two funds in front of you when one charges a fee and the other doesn't? Do listen in to hear what Deepak has to say. Deepak, we wanted to make today's episode about fees, in particular profit fees or profit shares, and the various costs that fund managers and other people managing your money charge you for the privilege of managing your money. So I wanted to take a closer look at profit shares and first understand who can and who can't charge profit shares in the Indian landscape at the very least, because that's where most of our listeners are from. And just then dive into the logic behind it. I guess the thinking seems to be, and everyone keeps saying this both on sales calls or just when you talk to them, that the profit share is what gives you some sort of a skin in the game. Incentives rule the world, and if you get to share some of the profits you make for me, then you'll do a better job at managing that money. But I feel there's a bit more to this story, and that's what my personal experience has been. So I just wanted to dive into this with you. And I thought maybe we could start by just looking at some of the terms so that we all are on the same page here. Whether it's management fee, hurdle rate, catch-up, profit share, watermarks. Maybe we could start with that and then we'll build up to the argument.
Super. I think great time to talk about this as well, because, when we think about what it means to pay someone a fee, you look at the history of how this whole thing evolved, as in people couldn't manage their own money. They were like, okay, listen, we can manage our own money ourselves. We can invest it in stocks directly. But you know what? This person, Shrey, knows better. So can I give him my money and say, you manage it for me? And that way, I think I can make the better profits or whatever it is. Shrey's not going to do this because for free. He's going to be like, listen, I'm going to do this for you, but I'm going to have to charge you a fee. So one standardized way that everybody started off was a management fee. The management fee was saying, just to manage your money, I'm going to have to put resources, an office, buy a bunch of subscriptions. All that's going to cost me. I'm going to give salaries to my analysts and all that stuff. I'm going to charge you a certain fee as a percentage of the money you give me. Regardless of whether it goes up or down, you have to pay me that fee on a consistent basis, because that's going to be what keeps the lights on in my office. But more importantly, this is almost akin to earlier people having had to pay salaries to kind of say, okay, I'll hire a person, he'll manage my portfolio, I'll pay him a monthly salary, and that person manages the portfolio. A management fee is a slightly altered version of that, where you say, okay, well, this person is managing funds of multiple people. Obviously, he's got to have to charge more for people who give him a lot more money, because that takes more time and effort to manage, and lesser for people who give him lesser money. So it's a percentage of the total capital or the AUM, the assets under management. This is a management fee. Now, there's a bunch of fees on top of this. You can tack on like GST, custodian fees, and all that stuff. So these are pretty much standard fees that are roughly either fixed or a percentage of the funds managed. Most mutual funds, at least in India, all mutual funds in the world, most mutual funds cannot charge anything beyond this. There's a management fee, a total expense ratio, and that's that. In this management fee, usually are embedded any of the other elements that you might be paying. And for instance, you might be paying commissions because you don't know the fund manager directly. There is a distributor or a friend or a bank who's saying, I know the fund manager. But in order to get to him through me, you're going to have to pay me a percentage of whatever fee the manager charges. Now, this is all hidden from you because you're literally saying the bank manager's charging me 2% a year. I don't care. Now, the manager pays 1% a year to the bank as a referral commission, which is like half his fee, which is how typically commission structures are. So you end up with a situation where you're going to pay 2%, but you're not paying it out of your pocket. You're paying it out of the assets that you've given the manager to manage by itself. So it's like a seamless fee internally built in. You're fine with that. But then people went a little bit beyond, saying, listen, you actually earn your money regardless of whether the market goes up or down. So can I incentivize you to make a profit for me that is so good that I would love you to participate in the higher fee and therefore make a higher profit and make some of a greater return than what you would otherwise make? So, well, the fund manager says, fantastic, tell me what we can do. We can share the profits above a certain percentage. So maybe the first 10% is yours. And then above 10%, whatever I earn, I charge you 20% of that. So if I make you 15% and the base rate is 10, then of the extra 5%, I charge you 20%. So I charge you 1% more apart from the management fee. This is called a performance fee. Now the 10% number is called a hurdle rate. And that hurdle rate is basically, if I jump over the hurdle, is when I start charging fees. But unfortunately, we're in the finance world, so therefore life is not as simple as just that. And now there was enough demand for fund managers where fund managers could dictate a little more and said, listen, I made a lot of money for you. Why should I forego the first 10% also? If I make you 20%, I'll charge you a fee on the entire 20%. So the hurdle rate is 10. Above that, I charge you, but I charge you on the whole amount, not just
from 10 to 20.
The slabbed increase, because this is called with catch-up. So without catch-up is whether up to the hurdle rate, you don't make any money, charge any performance fee, and above the hurdle, you charge a performance fee. I mean, if you make more, it's a fee with catch-up, which is also, by the way, something that's in your agreement, which probably written as, a small subtext. But you have to understand with catch-up means they're going to charge you on the entire amount of the return, regardless of what the hurdle rate was. And then this has even gone a level further, and you might now hate me for this, but this is how unfortunately it happens. Some people define a catch-up is a catch-up from the last time I charged you a fee. So let's say, I ran with you a couple of years and then I charged you fees and your portfolio was 100 rupees. And then your hurdle rate is 12%, saying I won't charge you any fees till 10%, but it's with catch-up. So 3 consecutive years, I make you 10% each. I have not charged you any performance fees. And this is 10% after management fees. So 10% a year. So 100 became 110, 110 became 121, 121 became 132. Now you're thinking, okay, you know what? Deepak has done 3 years and he's not charged me any fee. The 4th year, I give you a fantastic year. I charge you, I make like 15 or 16%. Now this 132 has become 150. Now you're thinking, Deepak, you didn't charge me. I mean, I was at 132, right? So now you're going to take the 18 and charge me that 20% performance fee
on 18.
On 18. So that's 3 rupees 60 paisa. Well, the way I have defined it in the agreement is to say with catch-up is from the last time I charged you a performance fee, which means I have only last time we started with 100. So I charge you the entire fee from 100 to 150, 20% of that. So you pay me 10 rupees, not 3 rupees 60 paisa. Now you're thinking, my God, what is this? But this is how catch-up is defined in a lot of agreements. So you have to be careful of what you're looking at, but it can mean a significant difference between what you think it is and what it actually is. So maybe some of these scenarios should be, you can run it with your fund managers when they talk about profit share. Usually profit share or performance fee is exactly what is charged. Now, we don't charge one Capital Mind, but when you have at least Capital Mind PMS, we don't charge it. But this catch-up concept is from the last time you charge a performance fee is part of a lot of agreements. And people don't realize it in these contexts. Then there's something called a high watermark. The high watermark means that if I have charged you a fee to a certain point, beyond that point, when I can charge you next fees. Now, this means that if I have charged you fees all the way from 100 to 140 in 1 year, so I charge you 20% of that, so I'm left with 132. Now, the subsequent year, my 132 went down to 115 because the market is a bad thing. This sounds like, oh, Deepak can't charge me a fee now. But I could say that the year after that, 115 goes back to 132, I can still charge. But then I've already charged you. I've made this profit in a previous year. I've charged you up till 132. So I should only charge you if the portfolio goes beyond 132. So it's my job to first get you back to the point where I last charged you fees and then charge you fees for whatever's beyond that. So this is called a high watermark, saying the watermark keeps going up as I charge fees. And then I'm not allowed to charge fees until my portfolio has reached that point where the high watermark was next. This is great for a one-time investment. It gets very complicated if you do constant investment. So for instance, every month you want to add some money and so on. So each of these, every month you add money, has a different profit sharing Excel calculation for each one. So that means if I've given you money in July, then I calculate from July to the next July. Then I give you more money in August. Then that installment is carried on from August to the next August and so on. So it's more complex when you have a multi-layer investment structure. But to that, what happens in companies like VCs and versus the AIF PMS route. AIF PMS, what happens is they charge you a management fee or whatever it is, management fee in particular, based on actually transferred money.
This is what AIF does.
For PMS does it.
PMS.
The AIFs, again, there are three types, Cat 1, Cat 2 and Cat 3. In the Cat 3 AIFs, you typically have to charge only on the money you receive because that's the only money you can invest. In Cat 1 and Cat 2, which are typically VC funds or debt funds, they do it on a percentage of committed capital. That means you've not even transferred the money, but the 2%. So I could say I'll give you 100 crores and you draw down only 5 crores. But the fee is 2% of 100 crores every year. That means I'm going to pay you, I'm going to charge 2% a year regardless of whether I've drawn down the whole 100 crores or not. So this is a slight difference when it comes to it. I'm sorry for having brought about so many concepts in the same thing, but that's the fee structure.
We'll actually we'll write these out in the notes or something so that someone can see them. I think catch up is the most dangerous one because you don't really know what your profit share is. I thought of one visualization which I was using when I was figuring out fee structures is, let's say you give someone 100 and they have a hurdle rate of 10%. Okay. For the first 4 years, they'd return nothing to you. So 100 stays 100 for 4 years. In the last year, they make 50%. So 100 goes to 150. Intuitively, my sense of fairness or understanding is, look, a 10% hurdle meant that 100 should have been, it's more than 150, but let's say 150 in 5 years. But you gave me nothing for 4 years. But now in the 5th year, you've made 50. And what are you going to charge your profit share on? I mean, I think this apparently needs another word called compounding hurdle or something like that.
In fact, many people now, what they do is they do an agreement that says over a period of 5 years, I will not charge you any fees until the 5th year, performance fees until the 5th year. And in the 5th year, I need to have compounded your earnings by so much. Otherwise, it doesn't make any sense. Now, many VC funds do this almost by nature because they are illiquid investments. So they can't charge you per year anyways. They have to charge you only on exits. But for most of the others, the IRRs, if they are done on an annualized basis, every annual basis, you end up with a situation where one good year, and there will always be one good year in any 5-year period, is going to give you so much of a fee, heartburn that you're going to be like, listen, I need a better structure. So this compounding hurdle is a much better way to do things. And I think now, as more transparency has come into this universe, we're seeing a few PMS managers, do it this way. Now, the reason many of them don't do it this way is there's no cash flow for 5 years. So, for instance, I'm only charging a management fee that's just meeting my costs. So, my real profits come from the profit share, if you think about it. And then I get that profit only after 5 years. So how do I motivate employees to stay for 5 years and make that massive pile when they can't even see it? And there's no cash flow in the middle. So many people say, listen, on a yearly basis, we'll do it, but let's compound it so that my hurdle rate is not touched, or rather, I have to touch the hurdle rate on a compounding basis since you invested.
Fair. Let's go to the other side of the argument, which was, I think it was skin in the game, right? So it was, the reason this profit share exists is because incentives rule the world. And if you give someone your money to manage, they can either play it safe or swing for the fences. If you want to play it safe, go to someone like a mutual fund, I guess, who can't really swing for the fences. But if you want someone who does something a little more interesting or extraordinary for you, you need to make that worth their while. And the only way you do it is by saying they can share in some of these amazing returns that they get for you. And that's the logic for the profit share. Do you believe in this? Because I often feel that people's investing styles are their investing styles, and they do what they were going to do anyway, and the profit share is the post-fact justification. And since I bring that up, you or we don't charge a profit share in the PMS. Why did you do it that way?
Let me ask the second question, answer the second question first. It's very interesting because we want to make a business profitable from the economics of the management fee itself. Sort of like the mutual fund industry, because of two reasons. One is, of course, if you get too comfortable with the performance fee thing, and the performance fee thing is very lucrative for the manager, undoubtedly, because we have done a 25% odd annualized return on what is a 2,200 crore portfolio. So just assuming that this 25% happened in the last year, our share, even if it was 10%, would be 50-60 crores plus. Now that's a life-changing amount for a small business like ours. But we decided actually that we won't do it like that, because we would not be able to scale this beyond a few thousands of crores, and that isn't really the hallmark of a large institutional business. And we don't use leverage. We can't as a PMS. And I feel that at some level, that is also what is required to swing for the fences. You need to be able to take leverage at the right time. When they say back up the truck and buy, you need to have something to back up the truck into. If you're fully invested and you're not allowed any leverage, you can back up the truck, but your truck is full. You don't have space to add more at that point. So leverage is what gives you that. And we can't use leverage. But I think here's the thing. Incentives is right. But all thing I've described about profit shares is that a profit share. There is no loss share, which means if you make money, I make money. But if you lose money, I don't lose money as a manager, right? So at some level, that was another unattractive feature of the profit share business that kind of kept us a little wary about this. But the more important thing, and here's a very interesting part, we wanted people to be able to invest every month. Imagine the calculation nightmares that people have to go through to figure out what fees they have to pay us if they're adding money every month, because it adds layers of complexity to everything that we're doing. We're facing that in the AIF where we charge a profit share, but we found that the AIF is more usually a lump sum investment. So people don't expect to invest it, in it every month for the most part. But because we aren't we are not doing this in the PMS. We don't have any of these complications there at all. But let me ask you this. If the profit incentive is real, then it means that you're telling me that I can profit on the upside but not hurt on the downside, which means I could take too much risk on the upside. I could make an enormous amount of money when the market is going up, but lose an enormous amount of money when the market's going down. And it's asymmetric. It helps me only if it incentivizes me to make money on the way up. And here's the problem. On the downside, everything is fine if it's only 10%, right? If markets fall 10%, I have to make back 10% for you too. And then I have a team. I have incentivized them also, saying, listen, you guys help me make this back, and then we'll all share into this profit share. However, what happens if the market's down 50%? This is where you have an issue, because now I've lost 50%. I need to double your money from here before I can charge you a performance fee. If I've linked my people's bonuses to the profit share that I can charge from the fund itself, the employee that I have is looking at me and saying, Deepak, I could stay with you. I have to help you double your money and double the customer's money, and then I can get charged a fee. But whereas if I leave and join this competitive fund, which is just started, I could actually start making money from day one on those customers, right? So essentially for the same work, in the next year, I will get rewarded more if I go away to some other place. Now, how do I retain these people? So in the end, what will happen is two things. First, people will get disappointed that I've lost 50% and they will leave anyways. So it doesn't help them at all. Second, the people who stay will be disappointed because my team is dwindling and I've lost incentive, because for the first 100% I don't get any reward at all. So it's the opposite of an incentive. If I have based my real profits on profit shares, then it's a waste of time. If it was a real kind of a structure that said, listen, I'm actually quite comfortable earning a management fee, this is just an icing on the cake, that would be fine. But that doesn't meet your logic of giving me an incentive, because if I was meeting my profit requirements anyway with the management fee, what incentive do I have to earn profits for you anyways? It's anyway icing on the cake. I still have the cake. So at some point, you have this problem of asymmetric risk, both for the upside and the downside. The downside risk is that your fund manager, one famous fund actually shut down their entire PMS, saying that we're down some 80% in 2008. And then, they went back to the same customer saying, listen, now we're starting another fund. So, imagine the guy who's just lost 80% and said, okay, fine, we're done. These guys are shutting down the fund. They're not going to do anything. They come with the same salespeople for another fund saying that we'll start charging you fees from day one. I'm always like, listen, I got to make back my 100% before you start charging me fees. But since it's a new fund, you're going to start from zero again and start charging me from day one. So it sounds a little incongruent, and it's only visible at times when you have a deep fall. So I think the earlier funda was also that, listen, it's Deepak Shah. He's going to risk his reputation for not doing so. Deepak Shah is going to work his ass off to just get you back to even and then start earning you returns. So you've got names like that. You got a Bharat Shah, you got X, you got Y. All of these guys were powerful names who did not want their reputation soiled, and therefore they were incentivized to kind of get you back to even and then start making you more money. But today, a lot of fund management entities are run by banks or by large entities which are largely faceless. You don't even know the names of your fund managers. And to that extent, you don't really care. There's no social pressure to kind of, keep it that way. And what social pressure in the end? Because if the guy is famous enough, where we've done another podcast with this, there is no downside in the financial markets. People beyond a certain point, they just stay.
Yeah, people lose money and the world forgives them and they just do it again. So a few follow-ons here. First, your description of the asymmetry in this profit share not being a loss share is like, look, heads we both win, but tails only you lose. So it's clearly not a very favorable situation. Second, when you talked about this, how you can't incentivize your team, I faced this personally, where at some point, many years ago, we gave some money to some real estate fund. And it's not doing very well because I think the timing was unfortunate. So we just got in at the top of the cycle. But at some point at the bottom, the same team was like, look, this is never going to really make its money back. So now, obviously through intermediaries, it's like, if you want us to stay, we need a sweetener. I was like, but you've just lost this. And anyway, they made it back eventually in the end. But you realize the asymmetry in the power dynamic, where they're like, all you can do is yell at them and complain. But they have to care about their careers and they will move on. But I wanted to address one more point, because you talked about this. So does it mean that people who charge a management fee end up like wanting to create very large institutions and become asset gatherers, and people who want to charge a profit share end up keeping their funds very small and end up focusing on creating some super normal returns by virtue of small size? Is that a dynamic you see playing out?
Yeah, I think, that's a great point, because one of the ways that I think you might want to look at this in a slightly different way is that the real incentive for the fund manager and this real estate fund also would have been if all these fund managers and the fund management team had a significant amount of their net worth in the fund itself, right? So you ended up with that being their skin in the game. So they lost when you lost and they won when you won. Of course, they made a higher killing from your performance fee, but they also had a significant amount of money in their own fund, which allows you to kind of feel slightly better, because you're saying, listen, even if they shut down the fund, they're hurting themselves as much as they're hurting you, and they're hurting their reputation and something like that. But I think the point that you make about, when you have skin in the game, and the part of the skin in the game that you have pertains to both your social reputation and your actual money. When you have that, the chances that you will be a pure asset gatherer becomes a little bit lesser, because now you're gathering assets from yourself. You're not gathering assets only from other people. And if the money the amount starts falling, you're going to hurt yourself a lot more than you're going to hurt yourself a lot, and you don't want to hurt yourself. So it's no longer the heads we both win, tails only you lose. It's heads we both win, tails we both sort of lose, and probably me more than you, because more of my net worth is in the fund as a fund manager, as a percentage of my net worth. Then you might give me 10% of your net worth, I might have 70% of my net worth sitting in the fund. So in the sense that I actually lose more as a percentage. You may have a much larger net worth, so your absolute amounts are greater, but the fact is that I do hurt. I think this is also some part of it is in a way the way that you change the perspective is to say that profit shares are inherent in financial asset management. For instance, when I buy a share of a company, I'm actually asking for a share of the profits of that company. So I am effectively telling the company, you make profits, I have a percentage in that. That percentage is based on the number of shares I own and all that stuff, but it's a percent. So effectively, I'm entitled to a percentage of profits of the companies that I invest in. A fund is simply that. The fund is entitled to a percentage of the profits it makes by investing in shares of other companies. So in a sense, I'm on the other side of that table. I'm giving the profit share, versus when I'm investing in a company, I'm receiving the profit share. But you don't necessarily have a lot of funds where people don't have any investments anymore. So a lot of PMSs, the principals and the principal officers themselves have a lot of money invested in their own fund. Sometimes companies, individuals who are running funds have their net worth invested in their fund. In mutual funds now, key executives of the mutual fund have to invest at least 20% of their salaries into the fund. So essentially they get skin in the game by regulation. But this is more like forcing intent, saying, okay, I want you to voluntarily put your money into the fund, not by a regulation that says 20% of your salaries has to go here. At which point you're pretty much like you're going to ask for a 20% raise by saying, listen, this 20% I can't touch anyway. You give me a 20% raise. I'm net even. But if I'm net even, I'm not actually incentivized to, make those supernormal returns on the fund. So in the sense, it's not voluntary intent. It's more like forced intent. And that does not add so much as skin to the game as I would. I think I may have answered only part of your question here, but that's my thought about skin in the game here.
No, I think it's a persuasive argument that if the person has a non-trivial amount invested, if the manager has a non-trivial amount, or the people working there have a non-trivial amount, yeah, they will hopefully care. But at some point, I think it depends on how big a percentage of the net worth it is, because at some point they may want to just say, look, let's cut our losses here and move on. But that's something potentially you, as long as it's not a liquid instrument, that you as a customer might be able to do that as well. One sort of worry that comes to mind is when SEBI or other folks mandate this, it's kind of forcing, if I may say, employees or people managing money to have both their labor income and capital assets in the same place, which is generally not a very financially sound decision, right? I guess it would be like those people who had, say, you're earning a salary from a company, but with your savings, you're choosing to buy the stock of the same company. I mean, if the company goes bankrupt, you're probably going to both be out of a job and your savings won't be worth very much. So does that concern you, that you shouldn't have this happen?
I think it would be the case if you were a operating company and your ESOPs were linked to that. But what you're doing over here is a fund is investing in other companies. If the fund was so for instance, the fund not making enough money as a direct consequence to you at some level as a part of your income as well. But given that your assets are not actually in the company's own shares, but it's in downstream company shares, you might actually say that investing through your company into the market is actually a function of what you're doing. Now, of course, it could be that your company does extremely leveraged stuff and just goes to zero. If that is the case, then you're right, because you end up with under diversification if you get your incentives as part of the company's fund performance by itself. But if by and large you're going to get, the market goes down, you also go down, the market goes up, you also go up, but you might go up more than the market, you're actually using your company as a pass-through to invest in other companies, which I think is fair to say that you should do as part of the skin in the game. It doesn't de-diversify you. It does, because your assets are not with the company. The assets are being managed by the company into other companies which they're investing in. So I think it's fair to say that for an asset management company, labor income and capital assets are actually not in the same place simply because of this.
Let me go back to my management fee only model. Let's say that you only have a management fee. What is really your incentive to do well there? Isn't your incentive, I'm coming back to that example, isn't your incentive just to get a lot of assets and just sit on them?
No, you're absolutely right. In fact, it is. But is there an incentive to make you money? The answer is this. There is an incentive by simply saying that if I double your money, I get double my fees because it's the same 1% of double the assets now, which means I'm already going to make more money from earlier if I managed more money, which is basically the same money that you've given me, which has grown. We're not a VC fund, we're a PMS. So which means that if you give me 100 and make it 200, I'm going to charge you on the daily average of whatever it was between 100 and 200. So net I'm charging you on 150. That's a 50% higher fee than if I had only 100. So my fees are growing as you're growing. But I'm also going to double dip on the profits if I have a profit share, right? So in sense of if I made you 100 to 150, I made you 100 to 200, I'm also going to charge you a percentage of this extra 100 that I made you and get 20% or 15% of your economics versus getting only 1% of your economics. So in the sense that I think there is an incentive, it's just not as great as a profit share, but there is a loss as well. Because if I lose you money, I make lesser money on the management fee. If your 100 becomes 80, I can charge you only 1% of 80, not 1% of 100. So in that sense, that helps me. The second thing that it does is that if I do really well for you, you will probably add more money to my fund. You'll refer other customers who will give me more money as well. So if I make you enough money, I will actually get more assets into the fund and charge a higher management fee in the first place. So this would be the gathering assets argument, but I can only gather assets if I show performance. I can very rarely of course, many times I can, if I'm really, really famous, I can gather assets without having anything like, I don't know if Donald Trump decided to raise a fund, which he has probably done in this crypto world already. His fund, regardless of his regardless of ability to manage any money, would raise probably $100, $200 million, $500 million just because he's Donald Trump. But I think not everybody has that kind of ability to do it. So to that extent, only performance can allow you to retain funds over the long term. So my incentive, even as a person who charges only management fees, is to keep performing.
The way I think about it is, look, if I double your money, I'm doubling how much money I make every day. And if I halve your money because I'm so bad at managing money, then I make only half as much. So there is an incentive here.
Yes, and there's a downside risk because I could lose all the money that you gave me by you taking the money out when I do badly. So my risk is not just 50% of, I could lose 50% of my assets as well. So if I made 100 into 50, I could lose 50% of that 50 and now have only 25 left. So I have a asymmetric downside as well.
Fair. Of course, the profit share side will say that, look, people can take it out of me as well. But anyway,
yes,
that point is taken.
Of course.
I was just wondering, can you talk about the principle of when it makes sense to charge for a profit share? You alluded to how things like leverage could help. And I guess at some level, keeping a small size is in some way a form of trying to help you get better returns. But how do you think about when it makes sense to charge a profit share? And my personal discomfort with this comes with, as I said, I think oftentimes people invest the way they want to invest, and the profit share is just what they can get away with. But wanted to ask from you, when do you think it makes sense to charge a profit share?
Oh, this is great actually. Let's look at it from the first angle. The first angle was, can I run a small fund and make a lot of money? It makes a huge amount of sense to do this because a lot of small companies are relatively undiscovered, relatively under-researched. Therefore, if you have only 500 crore rupees, not the 5,000 crores, 2,000 crores and all that. And in 500 crores, I can actually invest in a lot of tiny cap companies, many of which can give me a 20x, 30x, 50x return. Now, the absolute fee that I might charge on a 500 crore portfolio per year may be only 5 crores. Now, 5 crores is not enough to run a, say, 10-person analyst team plus X and plus Y and plus Z. So you're thinking this and 5 crores is just about keep the lights on. But that 500 crores can become 1,000 in a year. I could get 100% return because I'm investing in a lot of small caps which will get discovered. Now, if I do a 500 crore doubling to 1,000 crore, and I charge 10% of the profits, I could straight away make a 50 crores on top of this as profits. Now, this is great because at the end of that first year, I'm taking the 1,000 crore, giving back 500 crore to customers and saying, listen, I'm still going to only manage a 500 crore portfolio. Great lifestyle business, very interesting because you can get to gather a lot of small investments. But the problem is the size was so small that I could not survive on the management fee alone. Therefore, I need to charge a profit share, and I think I can because I can make supernormal investments, right? Now, where you shouldn't perhaps, and I'm saying this without any judgment, is like if I charge you a percentage of profits to invest in, say, mutual funds. So you give me money and I'll put it into mutual fund and I'll charge you a percentage of the profit. I can charge you a management fee, but if I charge you a percentage of the profit, think about what's happening here. Your mutual fund manager does not get a percentage of the profit. The guy who's actually making the investment does not get a percentage of the profits. The fact that you chose him versus somebody else, you are able to charge a percentage of the profits, and the mutual fund guy doesn't even know that somebody is making a percentage of the profits. So to that extent, why is the customer paying any of this? Why are people selling this? I don't understand, but it's nice, and if you can make it, you can make anything look sexy if you package it right. But at some level, charging a profit share on a mutual fund combination of portfolios almost sounds like, oh my God, what's happening over here? That's extent. But I would be happy, for instance, that to see that some people have actually done this in the past. And now a guy who's done it, I can't say everything is illegal. For instance, there was a guy in the 1980s who said, I will buy an equity fund and then I will buy a bond fund and I will switch your investments between the two based on certain complex interest rate currency cycles. And when I do that, this guy, he was interviewed in the Market Wizards by Jack Schwager, apparently had a 20% annualized return for over a decade by just doing this, shifting between equity funds and bond funds. I think that's fine because that's a very actively managed, regular trading-ish kind of portfolio, which was designed to make people, certain types of people, extremely high returns. Now, I think that is fine, but pure mutual funds for long-term investment may not sound like the greatest thing to pay a market share of, and so on. I would say, if you did this, then you would probably again be limited with size because you can't take 500 crores out of an equity fund one day. But bond funds can easily absorb 500 crores. But if you put it into a small cap equity fund, taking out 500 crores from a small cap equity fund, I mean, the fund manager will probably call you and say, "Bhai, kya kar rahe ho?" Because I mean, how or what are you doing? Because if you're doing something like this suddenly overnight and trying to move money into a bond fund, the poor guy can't find the liquidity to sell those small caps in order to give you the money in the first place. So to that extent, you jeopardize your returns by doing this bond shifting thing, so on. But such opportunities are relatively small. I mean, I think the number of opportunities that allow to shift from one mutual fund to the other and still charge a profit share is relatively small. But people become asset gatherers over a period of time because they see that the opportunity size has increased to 5, 10, 15, 20,000 crores. And they are able to get more and more customers who can sign on, who just want people to manage their money well. They just get those assets on board. And people are like, listen, I like this team. I think they're a good team that manages my money. They can forecast things to a certain extent. They have certain algorithms perhaps or data that helps them make decisions. And to a certain extent, I trust the team to manage my money well. When you choose a person based on this, your fees, like you just said, are largely irrelevant. People don't look at fees as a deal breaker. As long as they feel that they're not getting a really raw deal. For instance, my medallion by Renaissance has 5 and 65, 5 and 35% or something. So 5% management fee, 35% profit share.
We'd still give them our money.
Yeah, you'd still give because
they don't take it.
Yes, the 200% per year. I mean, at this point, you're like, dude, take whatever you want. I mean, whatever in the end, if I get something that's decent, but they don't take people's money. And again, here you're going to choose. And now, why would you do this? Because they're beating people so much that so why would you choose a PMS? Is also because if they've beaten mutual funds by a respectable margin, then you're saying, listen, fine, take the profit share. If you're going to give me 30% in a year when the mutual fund makes 10, then I don't grudge you a profit share. And that's when I think it starts to make sense to say, oh, take a profit share because you're making this irrationally higher return, or you're using leverage. Because in case you use leverage, for instance, a guy who's faced the say COVID crisis, markets down 50% or 40%, and the guy suddenly says, listen, I'm going to buy Nifty futures for 2x your portfolio, doubles down, and then makes double the return when the market goes back up. That kind of a person is giving you a supernormal return by taking leverage on the upside as well. This makes sense, I think, to kind of give a profit share on.
I also wanted to think about other industries. Is this unique to finance? Because again, with finance, there's a question of, like, when you see the people charging, say, a profit share on mutual funds, there's an intuitive feeling of, look, does the other person really understand what's happening? I mean, how are you actually pitching this? I mean, they will, of course, argue this is consenting adults. I'm going and selling this to this person. He's agreeing. What's your problem? Why are you coming and opining on this? You're just jealous that I'm selling more than you or something, or I can pull this off. But there is that sense that people are just getting away with it. Do you see profit shares in other industries, and at least in your experience, or other businesses?
So I think profit shares exist, of course, in many meaningful ways, most likely in the finance. In fact, Warren Buffett said this when he bought Salomon Brothers, and then he eventually sold it because he was like, I can't deal with this industry that seems to demand a share of every profit, despite the fact that they've made me losses in the past. So they're not just trying to help me recover the loss, but just to help me recover the loss, they want to charge a profit share in the first place. So that is a problem, because a lot of traditional industries don't do something as badly as that. But I think to a certain extent, there is a power dynamic in every industry that says, and there's a famous story that goes like this, right? A guy's got a very expensive, say, motor, and it stopped working, and they call this random obscure expert who's supposedly the world's most renowned expert in that one particular motor, and that guy comes along and starts whacking things around with his hammer and says, well, you know what, I know what to do. And he goes and gets a spanner and tightens one nut, and the motor starts working. And then he gives the bill of $1,000. So the guy looks at him and says, dude, you just hit something with your hammer and tightened a nut. I mean, why? Can you give me an itemized bill, please? So he said, fine, I'll give you an itemized bill. Tightening nut, $1, and knowing which nut to tighten is $999. So, I mean, sometimes the profit shares come as a benefit of experience. So you know you're going to pay a lot of money for someone to come and fix a problem that you know that people who don't have, and people accuse a lot of, so in the tech industry, for instance, you know that the persons who can fix bugs, which are complex bugs, are going to be ridiculously expensive. And you can't even have them on board for most of the time, because they might be great at doing a bunch of things, but they come in during crisis situations and then they fix things. And this may not be bugs in terms of the code wala bugs. It may be an infrastructure issue. You're getting hammered from some random guy in China who's trying to do malware and all sorts of things. And you need somebody to come and help you. So somebody needs to come in and set up this infrastructure so that this doesn't happen to you in the future, or that your systems are protected enough against malware if it hits them. So you're going to hire this kick-ass person, pay him 2x or 3x more than what you would pay anybody else. And the incentive for that person, although it's not a profit share, it's more like limit my losses in that sense. You're actually creating this incentive that says, well, you know what, I'll do it like this. But there are other places where a lawyer, a CA firm, many of them take percentages based on mostly professionals. So if I win a case for you, then I will. India, you can't do that, but most foreign people can. They can say, can you give me a percentage of what you make? Many investment bankers take a percentage of, say, IPO. I do a lot of work for you. I raise a lot of money for you. I'll take a percentage. Oh, of course, that's still finance.
Still finance, but
Yes.
it's slightly different finance.
A different area. Instead of managing money, I'm raising you money. A loan intermediary will take a percentage. Sometimes in businesses, we've had a situation where a person comes with a referral fee saying, listen, this is a contract which is worth, say, $50 million. And I'm going to help you get the contract. So I need a 2% of whatever is eventually negotiated. So 50 million may be the top line figure. But if I negotiate it down to 40, then I want 2% of that 40. And if I make it up to 60, I want 2% of the 60. Typically, companies in the VC space, when they're either buying or selling companies, pay such commissions to intermediate investment bankers. But this also happens in structured deals. So, for instance, it's biggest in defense. And one of the reasons why India got gets such flack from defense is India is the world's largest defense importer. The defense intermediaries called I forget what they're called, the arms dealers. The arms dealers make a significant percentage of commission from the people who sell the arms, right? So you get me India to buy my, I don't know, Tomahawk missile or whatever it is. They get 5% of the cut. And these arms dealers have become ridiculously rich by doing that. And India is the world's largest defense importer because it manufactures nothing by itself, because part of those commissions that are earned by people go into people's pockets in India. That ensures that we continue to be importing. It's only changed in the last 2 or 3 years, but it does happen in other industries, what I'm saying. There's a percentage made. I mean, famously in Bangalore, there was the whole corporators and a bunch of people who said we build roads, but we can't build roads anymore because the government wants 40%. So it turns out that government was removed, and the next government which came in also demanded 40%. So, at some point, this profit share seems to be embedded into cultures, if you may.
I think it's a bit here, as you said, it's more like a commission, but I
Yes.
take your overall point that people can get pay. I thought of one counter argument to my own thing about how where SEBI has basically come in and said, look, if you are the traditional middle class person we care about, then I am going to be very careful about what fees you are being charged, because you are not ultra sophisticated, you don't have much bargaining power, you have a job to do day to day, you just need this money to do well. So I'm going to be very strict on how much mutual funds can charge. I'll be even stricter on how much RAs can charge, till the extent that some of them may want to shut down their business. And I'll be even more strict on how much RIAs can charge. So everyone who can interface with a middle class customer is extremely buttoned down and restricted on what they can do. But at some point you can't create the nanny state. So if you're rich enough to pay 50 lakhs to a PMS or 1 crore to an AF, then you're on your own. And if you can afford money like that, then you should be able to spend the time figuring out how to invest it and what fees to negotiate. Do you buy this argument that if you're rich, you're on your own, it's fine?
Yeah, I think, this is actually where I have two parts of this argument. One is, I think the point about whether a person can charge more fees has two layers. One is the lack of transparency of fees itself, which I think accepted that the unsophisticated investor may not be able to see through a lot of this stuff. But effectively, the tyranny is of supply-demand mismatch. The number of good managers who are famous enough are relatively small. So if you want this person, you got to pay the fees that they are giving, and if you're rich enough, you're going to have to pay them. So the person who's got that kind of returns is probably saying, I'm willing to let you in on those returns. Like the medallion fund is only if I want or like your face or I've woken up in the right side of the morning or something like that. Hermes sells a bag for 2 lakhs or even 20 lakhs, right? At some point, people are willing to pay that 2 lakhs.
I think it's 20 lakhs.
20 lakhs. Okay, maybe. Sorry, I'm terrible in these things. But assuming that it is 20 lakhs, you can't go to Hermes back and say, sorry, but this is just a bag. Because they're going to be looking at you almost like, who is this alien in this universe who thinks Hermes is just a bag? But it is just a bag. It's a utility function. At some point, if you can't go back to a fund manager and say, you gave me just index returns, but you're still charging me fees on it. The guy will, that's what you agreed on in the first place. That's why maybe 1 year I gave you index returns, but doesn't mean that I will charge you any lesser on fees on that. And nobody can predict the future. I think also people sometimes invest basically thinking, if I invest in this fund, it's run by this fantastic guy who's got this fantastic community. So I will get the ability to network with these fancy individuals. I know this is not very valuable for a lot of us, but it is valuable for a lot of people to just be known that I have this label that I've invested in ABC fund, and this ABC fund is managed by this fantastic guy. And, so I think that also adds to the reason why good performance, high performance fees are charged. Now, a lot of things that SEBI says equates having a lot of money with sophistication. By and large, this is true because people having more money can take more losses and not basically the thing. But it doesn't mean necessarily that they're more sophisticated. It just means that they have more risk-taking ability. Now, being less sophisticated means that at some point regulatory barriers will ease up, saying, if you're more sophisticated, you'll be able to understand this fee structure and so on. We've seen a recent case where a multi-billion-dollar fund running from the US was making some trades in India through a person in Singapore that they designated their manager. That person apparently used Ketan Parekh as their co-entity to do some front-running business, where Ketan Parekh would apparently buy stocks in the exchange before. This person would tell the brokers in India to sell this fund or buy this funds, some stocks, and then Ketan Parekh would provide them in the market. Now, you would argue that is this really a fault of whoever the Singapore entity was or Ketan Parekh, when really the whole thing should have been monitored by the sophisticated investor running billions and billions of dollars, who should have been very much in understanding of how this whole thing, because they apparently knew that the Singapore entity was doing this stuff, the Singapore person was doing all this stuff, but they just pretended to think that they had no systems in place. Because when you look at the behavior, you're almost like, listen, all of this is suspicious, somebody needs to get in on the act and understand what's happening. But it would have been the job of the fund. If that had happened in our company, we would be raising red flags all over the place. But then, SEBI is required to be a nanny even of that person versus compared to everything else. So the regulatory, thought process, I think is, you have to have a standardized structure at some point. But I think you for instance, I mean, in insurance, people have done that. Things like, oh, you know what, you invest 100 rupees, for the first 2 years, your 100 rupees is mine. It's like 200% commissions. The third year onwards, you start getting, so it's commissions. It's not a profit share. But what profit? Your money wasn't even invested. It's like,
try getting your money back in year 3 and see what happens. This is the most painful experience I've had in my life.
Yes, in terms of it's like, you really have a worst enemy, you should buy them an insurance plan. It's almost like
you're giving us ideas with how to get revenge on people. Okay, fine. So maybe as I'm coming towards the end though, let's say that you're someone who's made it to the end of this podcast and you've heard out your arguments on the pros and cons of a profit share. And then tomorrow, 2 people are showing up at my doorstep. One of them is selling me, say, some great mutual fund that's done really well over the past many years. And either they're saying do it directly or pay me a commission as a regular plan. And the other one is some incredible fund manager who may or may not be there themselves, who's offering an AIF or PMS with a profit share. How would you decide whether it is worth it to go with the PMS/AIF with the profit share versus just doing either a PMS or AIF without one or a mutual fund?
So I think it's a very, very good question. Firstly, I think on hygiene basis, I would encourage you to look at the structure of the performance fees and say, is this with catch up, without catch up, 5 years, 4 years, what is it, absolute, compounded, all this stuff. But more importantly, what's the objective of the fund? And I think 2 objectives make a lot of sense. First, if a fund targets a high absolute return, when I say high absolute return, it means regardless whether the market goes up or down, I'm going to try and beat the market. Now, if I try to beat the market on the downside, which means necessarily I have to have some exposure that is short. So if I'm going to have an exposure on the short side and I'm going to be opportunistic about it, so that means I'm going to not be short when the market's going up and be short when the market's going down, and therefore earn a return regardless of which direction the market's moving. Exactly what the Medallion Fund does with, say, Rentec or a bunch of others, who then I think absolute return targets where your risk-free return is what, 8% today? Possibly somebody who's giving you 20% absolute returns, not risk-free, but absolute returns, or who's targeting absolute returns of 20% per year. I think that's fantastic to give a profit share for, because the guy is going to literally tell you, listen, any year, maybe intra-year you forget, but any end of any year, I want you to be able to see 20% on your this thing at least. Now, this is great because it gives me comfort that, at some level this is good, but you should know what he's doing, of course, and plus you should know that this manager knows what he's doing. A lot of people think that
it shouldn't be that option selling guy who makes you 2% a month and then vanishes.
Yes, and
1 year
then
later.
He just picked pennies in front of a road roller, the road roller moved and you're finished. And then, now you're putting police reports on the guy. So you should know what he's doing, and that's fine. The second one, I think, is a person who uses leverage, short and concentration, small caps. Small caps are a form of leverage in the sense that you know that they either will give you this 10x, 50x kind of return or go to zero. So in that sense, they're a little bit of the option kind of universe. And sometimes you get some great picks over there. Sometimes you get some really lousy picks. But the guy who's going down there is almost necessarily saying, listen, I can't take a lot of capital. So you're one of the few people who's going to be participating with me on this whole thing. So maybe I'll cap this fund at 200 or 300 crores, and then I will take it to 1,000 or 3,000 crores by the time we're finished, and then I'll return the money post my management fee. This is great because the guy is incentivized for the right thing. He's got a long-term thought process. You've got the ability for him to say, listen, at 300 crores at 1% a year, you're making nothing. You could make more than that in salaries if you went into the industry. But you're choosing to do this for me, get just about cost basis, and then wait for this 5 years before I get this supernormal return. Somebody who's doing that, somebody who's using leverage, who's saying, listen, when the Nifty goes down 40%, no, I am going to take leverage up my wazoo, go do options, do whatever it is and all that, and give you great returns. You can't do this as a PMS. Maybe you can do this as an AIF to a certain extent. But if you did do this, I think you deserve a profit share. And in our AIF, one of our objectives is in the long term to do things like this, which is basically that's why we're able to justify even to ourselves that there's a reason we want to charge a profit share, is because tomorrow when the time comes, we may be able to leverage it. We don't use it right now, but
That's
as we look at more algorithms and so on, there may be a point at which making leverage makes a lot of sense, and we know that there are those moments. It's just that last 5 years have been very kind to us. We haven't seen too many moments of those where you needed to have taken leverage to make supernormal returns on the upside or the downside. But when the time comes, I think that is where your scale of operations changes. I would say your choice of giving a person performance fees like this, you should be able to either get a great absolute return regardless of markets, or a fantastic return potential that gives you at least 2x or 3x market return. So the market's going to give you 12% a year, and we've kind of written an article on that. That's about the max you should be able to expect from markets. Then you should look at somebody who's looking at it, who's potentially going to give you. Now, no manager is going to tell you they can give you a 25 or 30%. The only way to look at it is their track record over pieces. So they're giving you 24, 25, 30% or so. That is when you're saying, fine, take a profit share. Now, remember that even without a profit share, companies like ours, like PMSs like ours, without a profit share, have already given you 24, 25% over the last 5 years. So your return expectation of people who give you this profit share based return should be even higher than that. At least that's my humble submission, is that sure, give you a profit share, but make sure you understand what profit share you're giving and pay it for the right kind of reasons, because it incentivizes the right kind of professional.
Two sort of questions off the cuff from that. So if you're a person who's very busy with your profession, or maybe you're an engineer at a fast-growing startup, you're a very successful doctor, a very successful lawyer, and you don't have time for all this, should you then just put your money in mutual funds and no profit share products? Because you don't have the time to sit and read through the 100-page PPM and figure out whether there's a profit share. That's question one. Question two, SEBI has indeed, or let's just use regulator in general. I mean, it doesn't have to be SEBI, but regulators have been very careful when the end product is consumed by the middle class or below that, and become much more hands-off when it becomes richer customers. Do you think that's the right approach on this as well?
So on the first thing, I think if you're a doctor, I mean, PMSs like ours also don't charge a management performance fee or profit share. So I mean, in the interest of not being biased, I should also say consider people like us. But yes, mutual funds qualify, so do PMSs like ours. Many PMSs do also have an option of saying no profit share, just a management fee. That's also fine. I think it just reduces the amount of effort. Although you have to fight your incoming thought process saying, I want to incentivize this guy to give me great profits, because the only way you can figure out that this is worth it is by actually understanding management styles. And you're a doctor and a lawyer, you don't have time to analyze it that much, so you may not have the knowledge. On the second front, which is sorry, go on.
No, or the engineer who's solving $100 every day.
So most people just want somebody to just take care of their money, and you shouldn't have unreasonable. So the problem with profits is also unreasonable thought process. You're going to make me money every year so that you can earn your profits, right? But you can't make money from the markets every year. It's impossible. So there isn't absolutely any time at which you should pay a profit share and create expectations that are supernormal and in your own head. What was the second question?
It was about regulators. Like
correct.
they're getting more hands off the moment the person gets richer, which is the proxy for sophistication, as you said. Not always true, but is this the right approach, or is there something they should do, either to just limit fees, force disclosures, force transparency, standardized format of fees? Do you think they should go there?
So I think, I hate to say add more regulation to this because we're already super regulated as we are. But I think simplifying the regulation to make sure that the fees are transparent is important. So, for instance, some of the things the regulator has done right is to say that, listen, you got to give various kind of, scenarios of fees. So, you got to say, as a PMS now, you got to say, oh, what happens if the first year I make money, second year I lose money, third year I do something. First 2 years I make money, third year I lose money, and the other way and so on. So, you create these multiple scenarios and then you kind of impress upon the customer what is great. I think also creating a layer of advisory, like the way companies get advisory services from institutions when they say, well, you know what, should you vote on this resolution or not? I'm an independent advisory service. I give you my recommendation on whether you should invest. A credit rating company looks at a bond and says, here's its credit rating. Everybody gets to see what the credit rating is. It's a third party, relatively unbiased interface into this whole thing. Maybe what is required is the same credit rating agencies, if you may, or something like that, just providing an unbiased standardized format. Not the regulator, not even the PMS manager, because the PMS manager will obviously be biased. You get a third party to say, here is how we understand this person's fee management structure, and that would be a simple one pager that would simply say, listen, these are the pros, across all the fund managers we've seen, this is these funds have catch up till last performance fee, these funds mean catch up like this, catch up like that. So they've kind of standardized the terms so that you reduce your need to interpret every agreement by looking at the fine print and so on. That may be an interesting add-on to the regulatory framework, but I don't think I should never say make it anything compulsory. Sophistication with respect to money is not true, but loss making with respect to money is definitely true. In the sense, you have too much money, then you can afford to make. But what happens is you have to ensure that the person who's giving you money is not over leveraged. The problem is most of this have got diluted because when people buy 4 crore houses and 3 crores of that is sitting in a housing loan, and then they put 50 lakhs into a PMS, the regulator says, so what, that's fine, he's got a 4 crore house, big deal. But to me, this is a person who has a 4 crore asset that is not worth 4 crores because they live in it. But he has a 3 crore loan. So technically, to me, this is an extremely leveraged customer. However, if a person takes a personal loan, adds 3 friends together and gets 50 lakhs, the regulator says these are bad people, even though they may have no housing loans at all. And only this 50 lakhs as maybe part of it financed by personal loans. So even for me to say that sophisticated people are people with more money and this thing, I think I would have a problem with that in general. I would feel the problem over here is at some level you need transparency, but you need to actually open up the rules, not add more. You just say, well, you know what? Here's the thing: charge whatever you want to charge. But be open and let other people give their opinions on how bad your fees are, whether or not you like it. So if you have an open and transparent fee structure, somebody else should be able to say, well, here's what it is with respect to everybody else. These guys are charging extremely high fees for something like that, because that's what ULIP plans are. They tell you their entire structures up front, and there's 5,000 videos created on YouTube saying, God, you guys must be stupid to buy this plan. And still people buy these plans because they see the YouTube videos after they buy the plan. So, but at least you have the YouTube videos. It's like X's or Twitter's new concept of saying community notes, right? So you want the openness, and you want the openness to contribute to say people are not good.
That's an intriguing idea, but I completely take your point. So on that, thanks Deepak, and thanks for opining about profit shares. I think I've had a mixed experience with them. As I said, I seem to think that the person managing your money often does it for the interest or the joy of doing it anyway, and their economics are pretty much sorted no matter what. So it really does seem to often be a question of what the person can get away with in that power dynamic or in that structure, rather than them doing something different because this structure or this profit share allows them to. But anyway, so on that, thanks once again, and see you next time.
See you next time. Cheers.